One of the exciting things about DeFi transactions is that it allows us to have significant financial innovation, new ways of doing things financially. One of those examples is the idea of bridging cryptocurrencies, where I take an asset that's on layer one and I bridge it over to another layer two. How is bridging taxed? And it's not so simple as just simply giving you a quick answer. It really depends on the way your bridging occurs. As I've researched bridging, and I've seen there's about five major methods that bridging occurs. One is using wrapped assets, another one is using a mint, burn, and release approach. Third one is liquidity pool based, swap based approach, atomic swaps with locked contracts, hash time locked contracts, as well as native bridges or side chains. Just to review the concept, when you acquire an asset at a price and then you dispose of, which would be a tax term, or sell or exchange would be the word that's actually used in the tax code, sell or exchange for another token, then you've incurred a capital gain event. So the challenge here is, when has that happened? All these are different ways that one might bridge assets. Well, whether it's taxable or not will come down to whether an asset is exchanged. So let's think this through. One way of doing bridging is to wrap the asset. So, for example, if I wrap something, where like I wrap a Bitcoin using a smart contract, is that a sale of the Bitcoin? No, it isn't. The Bitcoin is locked up. That address is locked up inside the smart contract, and it is not sold. The wrapped ETH may be used as collateral and different things, but a sale event does not occur unless you actually dispose of the wrapped ETH. The notion is, with that wrapped ETH, either you unwrap it, in which case you get your own asset back and there's no tax, or I dispose of it by giving ownership to someone else. When that ownership transfer happens, then you have a taxable event. And the question is, am I taxed on the value of the underlying Bitcoin or the value of the wrapped Bitcoin? In this case, the transaction would be the wrapped Bitcoin. And for you as the seller, you have a transactional cost, which would be the cost basis of the Bitcoin that is inside that. Now, a different way of doing bridging would be to have someone who buys your asset on one chain and then relaunches the asset on a different chain. And they're basically moving it from a fungal, because it's fungible asset, but they're changing the underlying layer one blockchain on it. But they're doing the swap themselves. In this case, you're experiencing a sell event when you initiate the bridge. So you actually have a capital gains event when I go to the bridge, and then the new asset that's being output is going to have a cost basis, the value of the bridging occurred. So as you can see in just these two examples, bridging may or may not cause a taxable event. It depends on whether or not ownership is changed from the original owner to somebody else. Now, that's all fine, and we can dig into the mechanics of that, and there's lots of subtlety. But then what would it look like to the IRS if we had to pull the records and explain what went on? I would not expect the IRS to understand the subtleties of bridging variations. They're going to see, was it sold? And if it wasn't sold, then they're going to say it's not a taxable event. Now, if it is sold, then they're going to see that and they want to know what the cost basis is. That's how they're going to drill into that question. It's also a very complicated question because it's not being done on centralized blockchains like a Kraken or Coinbase. Then there's going to be clear records that are reported to the IRS in a 1099 DA showing what the taxable aspects of that are. But if you're doing these transactions on DeFi, that's not being reported to the IRS. And so your challenge as you try to calculate your gains is to determine, whether this is taxable at that time or if you want to tax it later. I guess you should just think through the bridging methodology that you used. Was it a wrapping approach where the original asset is preserved, or is there actually a disposal on the one chain of an asset and the minting of a new asset on a different underlying blockchain? You need to think that through to determine if you have a taxable event.